Well, hello everybody, and thanks for taking the time to hear this presentation today. My name's Keith Cullen, and I am the founder and managing director of WT Financial Group Limited. So I'll start with a bit of a background on WT Financial Group for those of you that don't know us. We founded the business in 2010, initially under the name of Spring Financial Group, and our focus for the first 8 years of operation was a direct-to-consumer business with all salaried advisors providing financial advice to retail and wholesale clients. We built this into a sizable business from a zero start in 2010 to about $10 million worth of annual revenue, from zero clients to about 3,000 clients across that point of time. We listed on the stock exchange in 2015, initially under the code of SFL, and had a very strong dividend history, paying out nearly $7 million in dividends. In 2018, in the wake of the Royal Commission, we took a decision to pivot the business from its direct-to-consumer focus because we saw an enormous opportunity in what is known as the dealer group space, or AFSL licensee space. All of the banks and a number of the institutions decided to exit the advice space in the wake of the Royal Commission. And so we saw this almost overnight unraveling of what had become a vertically integrated model. And we saw great opportunity in that. We set out to unlock the value out of the direct-to-consumer assets that we had built by providing access to those assets to independently owned financial advice businesses around the country. Across those few years from 2018, we have acquired a business known as Wealth Today. Then we followed it up with the acquisition of Sentry Group, and more recently in March this year, Synchron Group. To all of the advisors in these networks, which is now some 400 advice practices and around 600 advisors, we provide a comprehensive range of licensing, compliance, education, training and technical support, practice development, including marketing and consumer retention tools, and business development services to them. And we have now emerged as one of the largest financial advice groups in the country. In fact, we're third behind the two institutions that have remained in the space in AMP and Insignia. So we've built a very sizable operation, some 400 odd practices with around 600 advisors, $16 billion worth of funds under advice, $360 million of in-force insurance premiums, and around $25 million of new premium sales per annum. So a very sizable operation that we've managed to build in the space of just 3 years, having made that pivot to business as opposed to business to consumer. Across this same period of time, we've disposed of a number of our B2C assets. However, we have retained a practice within the business that's an integrated financial planning, tax and accounting and mortgage broking practice that still operates under the Spring Financial Group name. And this is a really important thing for us in so much as it enables us to keep connection with what it's like to deal with clients and sit in a room with clients every day and bring that real world practical experience to the table for the advice practices that we support. This all comes at a time, of course, when demand for advice continues to grow. So over the last 3 years, we've invested some $25 million in these acquisitions and restructuring our business. And the primary driver for this is we have seen demand for advice growing. We're right on the doorstep of the greatest intergenerational wealth transfer in history. We've got about $3.5 trillion about to pass from one generation to the next. We've got the largest cohort ever entering into aged care, and we've got superannuation contributions going up at a statutory rate, which is set to see a doubling of current superannuation assets by the end of this decade. We've got increased demand for estate and legacy planning, for retirement income advice, for that aged care advice that I mentioned. And of course, we've got the cohort that are going to be the recipients of this wealth transfer needing strategic investment advice. So demand is growing, yet supply has been contracting with the exit of those institutions from the space. Looking at what our key drivers to revenue are. So how we earn our revenue is, firstly, we collect all of the revenue that our advisors are generating through advice fees and insurance commissions. Each of the practices in the group pays us base fees, and then we retain a percentage of revenue that the advisors within the group are earning through those advice fees and insurance commissions. We've got licensing advisor services revenue as well. We've got a range of services we provide to our advisors on a user pays basis around helping them manage their risk and providing a variety of technology solutions and so on to them. We've still got our B2C revenue as well, albeit on a much smaller scale than what we had before we took this pivot into B2B. What's that look like from a revenue perspective? Well, we've just put our audited results for the year out. Our revenue was a little over $100 million for a GP of about $11 million. And we're very pleased with our EBITDA line of nearly $4 million, producing an underlying net profit before tax of $2.8 million and a statutory net profit before tax of $2.35 million, which was impacted by some restructuring costs that we had there in restructuring some debt on our acquisition of Synchron earlier this year. So a really pleasing result. What's most pleasing about it is that we only completed our acquisition of Synchron in March. And so we had a $35 million contribution to revenue from just 3 months from Synchron, which has really put us in a good position for 2023. So we've got guidance in the market. You can see it there, 170 million going down to an EBITDA of 7 million and expecting a net profit before tax of 5 million for this year. So a really real change in the scale of our business. Board and management team, I won't bore you with too many details there, but you'll see it on the screen. Each of us has a very good experience in financial services. Our chairman, Guy Headley, our ex-Macquarie Bank, our non-exec director, Michael Harrison, ex-Shadforths, which was acquired by IOOF, and Chris Kalessis is my co-founder in the business and very experienced in financial services. Importantly, board and management are very aligned with shareholders. We have around 33% of the company shared between board and management. And then we have some very strong experienced financial services shareholders in there in UIL Limited, which is a UK listed investment company, Glenn & Small Companies, and IFM and also Ariadne on the register. So a really good team of shareholders, both institutional and also board and management, supporting this strategy in building the dealer group out.